This is a special report from Hollow Point Trading about a prop firm that the futures world is hiding from you. It focuses on options funding, offering defined risk, same-day funding, an 80% profit split, and accounts up to $1 million. Why risk your own capital and savings, typically $3,000 to $6,000, just to make inevitable trading mistakes? On a funded account, the firm covers the tuition, not your bank. This is crucial in today's volatile market. Trade with options funding's capital, not your savings. Pass a simulated evaluation and trade options on SPY, QQQ, or stocks with their capital. Your only cost is the account fee, never thousands of your own dollars. You benefit from defined risk, same-day funding, an 80% profit split, and the ability to scale to $1 million. Your worst-case scenario while learning is a number you choose. On a funded, simulated account, your downside is a defined max loss limit, not your bank balance. The biggest hit is the subscription cost, ranging from $1,250 to $5,000, depending on the account size. The bet is asymmetric and tilted in your favor. If you're wrong, you are only out the cost of the account. If you're right, you pass, keep 80% of the profits, and fund a real options account. Now you're trading on earned profit, not risked savings. Now, let's explore the difference. Why does a funded options account beat gambling with a futures combine? We will look at 5 structural reasons why most futures combines fail. Trap number 1. No floor. Undefined risk means the loss never has to stop with a futures contract. In contrast, with long options, your worst case is fixed the instant you enter. Your loss cannot exceed the premium. Trap number 2 is the trailing drawdown. It trails up but never trails back. The initial buffer, such as $2,000, climbs with every new high, locking in the level, and can be wiped out by a single undefined risk loss. Trap number 3 is that you don't own your exits. Futures firms force you to close before the session ends, meaning no overnight or swing trades. You trade the clock, not the market. Options, however, give your thesis room to work, allowing overnight holds and time. Trap number 4 is gaps and slippage. Your stop is just a suggestion. The gap is the reality. With futures, a stop loss only fills at the next available price, potentially far below where you set it. A long option fixes and defines your maximum loss to the premium. Trap number 5 is the one-dimension constraint of futures. You must be right on direction and timing. There is no margin for being early. Options give you direction, time, and volatility, offering multiple ways to win. The futures combined business model is simple. $50 in, blown out, rebuy, repeat. The cheap combine is a subscription to losing. The reset is the revenue. Do it once and do it right. Stop renting losses and opt for a properly funded options account. The futures world is hiding an options prop firm from you. They prefer you don't find options funding because it offers defined risk trading, same-day funding, 80% splits, and overnight holds. This is something futures combines can't offer. Section 2. Why options win. The structural edges futures can't match are anchored on one word: defined. The first edge is defined risk. When you buy a call or a put, your maximum loss is the premium you paid, not a penny more, regardless of market volatility or overnight gaps. It's known before you enter and chosen by you. You decide your worst case. The market doesn't. With futures, the market sets your loss with no floor. With options, your loss is set by the premium, and your downside can't grow. Options pay you for being right in 3 different ways: direction, time decay, and volatility. Futures only pay on direction, while options let you mix and match, providing multiple ways to profit. The third edge is time. Futures force you out at the close, but options allow you to buy weeks of expiry and hold through the night. This means you have time for your thesis to play out without being forced out early. The fourth edge, no liquidation spiral. Long options mean no margin calls, no auto liquidation, and no cascade. Your risk is paid in full up front, and the worst the position can do is expire worthless. The fifth edge, volatility is fuel. Big movement is raw material for options, allowing directional plays to have more room to run. While high volatility makes premiums more expensive, your risk remains defined. The scorecard shows the clear advantages of options over futures. Futures traps are solved by options structural edges, offering a defined and safer trading experience. This is Section 3, Options 101. We'll cover the fundamentals, calls, puts, the Greeks, and the defined risk plays that matter to your trading success. The 2 building blocks of options are calls and puts. A call is the right to buy at a set price, used when you expect price to go up. A put is the right to sell at a set price, used when you expect price to go down. Your max loss for both is the premium paid. The Greeks that matter are delta, theta, and vega. Delta is your directional exposure. Theta is time decay, which works against buyers. Vega measures sensitivity to volatility, where rising volatility increases premiums. The simplest plays are the defined risk ones. Buying a long call or long put offers the cleanest version of defined risk. A debit spread is a cheaper, capped alternative trading direction with a known max loss and gain. Debit spreads offer defined risk with a discount. You buy one option and sell another against it. The short leg lowers your cost and break even, resulting in a capped maximum gain, but keeping your max loss known upfront. The HPT playbook focuses on 0 DTE and SPY/QQQ options, where defined risk meets market structure. Short-dated options on liquid assets allow precise intraday theses with defined risk per ticket, guided by structural levels. Welcome to Section 4, Meet Options Funding. We'll introduce the options first prop firm built for precisely this style of trading, and detail the deal available tonight. Options funding is built for options, not as a futures afterthought. Pass a simulated evaluation, and you can trade SPY, QQQ, or any stock options with their capital. This firm is designed for options traders from the ground up. The path is simple. Learn, trade, earn. Sign up for a $25,000, $50,000, or $100,000 account. Trade options with firm capital, and hit your target. Request a payout anytime you're above the threshold, and keep 80% of your profits. You can choose one of two ways to get funded: the Express or the Growth Path. Express is fast and lean, with 0 minimum trading days. The Growth Path is designed to scale your funded capital over time toward $1 million. The Express plan offers $25,000, $50,000, and $100,000 accounts. Use code OF40 to get a 40% discount, lowering the monthly cost. For example, the $100,000 Express plan, the most popular, has a $10,000 profit target, a $5,000 max loss limit, 0 minimum trading days, and an 80% payout split. The Growth Plan also has $25,000, $50,000, and $100,000 options with a 40% discount using code OF40. This plan features a longer scaling arc toward $1 million. Crucially, when you reach the live funded stage on the Growth Plan, your subscription fee is refunded. The funding process is designed for speed and flexibility. Benefit from same-day funding, no time limit on the evaluation, 0 minimum trading days on the Express Plan, and the ability to request a payout anytime you're above your threshold. You keep 80% of every dollar you earn. There are no hidden tiers or surprise splits. Every payout, you keep 80% of your generated profit. You can request these payouts on demand once you're above the threshold. The fine print is actually beneficial. You receive a refund on your evaluation subscription once you reach the live funded stage. There is no activation fee to switch your account on. You can hold trades overnight, and 24/7 support is available. Options funding offers significant room to grow. You can scale your capital toward $1 million as you hit targets. You can also copy a strategy across up to 10 funded accounts, compounding your edge with every good decision. Trade on RIX, Options Funding's proprietary platform, built by traders for traders. RIX provides option chains, charting, and position tracking, purpose-built for options trading, helping you build discipline and make better decisions. This is Section 5, How to Pass. We'll cover the plain English rules, proper position sizing, and the survival mindset needed to get funded. The rules are straightforward. Hit the profit target and respect the max loss limit. There's no time limit, and the payout is an 80% split. Always confirm the exact, current rules on the options funding rules page before trading. The goal is to survive first and win second. Size your trades so that one wrong idea can't eliminate your capital. Risk only a small premium slice per idea, giving you multiple attempts before you hit the max loss limit. Stop buying cheap combines with undefined risk. Every reset is a sign that the system is designed to take from you. Do it once, do it right. Buy a properly defined risk options account. Take advantage of the limited time 40% discount on every account with code OF40. This sale ends tonight, June 6th, at 11:59 p.m. Eastern Time. This drops the monthly cost significantly for all Express accounts. Getting funded the right way involves 3 steps. 1. Go to the link. 2. Apply code OF40 for 40% off the Express plan. 3. Join the Discord to get the playbook and essential community support. Do it once. Do it right. Start your defined risk options trading journey today. Visit optionsfunding.co/ref equals HPT, use code OF40, and join the community at discord.gg/6TBZUUEMH.